In recent years, the global economic landscape has been marked by significant shifts, and one of the most notable developments has been China's move away from the US dollar. This transition is not merely a financial maneuver, it represents a strategic pivot with profound implications for the global economy. The decision by China to sell off a substantial portion of its treasury holdings and invest in gold has sent shockwaves through financial markets, leaving many analysts and policymakers in the United States grappling with the potential ramifications. China's divestment from US Treasury securities, which are often considered one of the safest investments in the world, signals a growing lack of confidence in the dollar as the world's primary reserve currency. For decades, the dollar has been the cornerstone of international trade and finance, allowing the United States to wield considerable influence over global economic affairs. However, as China continues to rise as a formidable economic power, it is increasingly seeking to assert its own influence and reduce its dependency on the dollar. The decision to sell off Treasury holdings can be attributed to several factors. First and foremost is the desire to diversify its foreign exchange reserves. As of 2023, China held over $1 trillion in US Treasury securities, making it one of the largest foreign holders. However, with the U.S. government running persistent budget deficits and the Federal Reserve's monetary policy leading to concerns about inflation and currency devaluation, China has been motivated to reduce its exposure to the dollar. By reallocating its assets toward gold, China aims to hedge against potential risks associated with the dollar's decline. Gold has long been considered a safe haven asset, particularly during times of economic uncertainty. Unlike fiat currencies, which can be printed at will, gold has intrinsic value and has been used as a store of wealth for thousands of years. China's move to bolster its gold reserves is not a new strategy. The country has been steadily increasing its gold holdings over the past decade. However, the recent decision to sell off Treasury securities to fund these purchases marks a significant escalation in this strategy. This shift has not gone unnoticed in the United States. The reaction among U.S. policymakers and economists has been one of shock and concern. The implications of China's actions are far-reaching as they challenge the long-standing dominance of the dollar in global trade. If other countries follow suit and begin to diversify away from the dollar, it could lead to a significant decrease in demand for U.S. Treasury securities, resulting in higher borrowing costs for the U.S. government and potentially destabilizing the economy. Moreover, the sale of Treasury holdings could lead to a depreciation of the dollar. A weaker dollar would make imports more expensive for American consumers and businesses, potentially leading to inflationary pressures. This scenario poses a dilemma for the Federal Reserve, which would need to balance the need to support economic growth with the risks of rising inflation. The Fed's response to these challenges could have significant implications for the broader economy and financial markets. China's decision to sell Treasury holdings and invest in gold also reflects a broader trend of de-dollarization among emerging economies. Countries such as Russia, Turkey, and Iran have been actively seeking alternatives to the dollar in their trade and financial transactions. This trend is driven by a desire for greater economic sovereignty and a recognition of the risks associated with being overly reliant on a currency that is subject to the whims of U.S. monetary policy. As more countries explore alternatives to the dollar, the potential for a multipolar currency system emerges, which could fundamentally alter the dynamics of international finance. The geopolitical implications of China's actions cannot be overlooked. The United States has long viewed the dollar's dominance as a tool of soft power, allowing it to impose sanctions and exert influence over other nations. As China strengthens its economic ties with other countries and promotes the use of its currency in international trade, it is positioning itself as a viable alternative to the U.S.-led financial system. This shift could lead to increased tensions between the two superpowers, as the United States seeks to maintain its hegemony in the face of a rising challenger. In response to these developments, the U.S. government must consider its options carefully. One potential approach is to strengthen diplomatic and economic ties with key allies to reinforce the dollar's position as the world's reserve currency. This could involve promoting trade agreements that favor the dollar, enhancing cooperation on financial regulations, and working to stabilize the global economy. Additionally, the U.S. may need to reassess its fiscal policies to address the underlying issues that have led to concerns about the dollar's stability. Ultimately, China's decision to sell Treasury holdings and invest in gold represents a pivotal moment in the evolution of the global financial system. While the immediate consequences may be unsettling for the United States, it is essential to recognize that this shift is part of a broader trend toward a more multipolar world. As countries seek greater economic independence and alternatives to the dollar, the dynamics of international trade and finance will continue to evolve. The ability of the United States to adapt to these changes will determine its future role in the global economy. As the world watches closely, the implications of China's actions will unfold over time. The potential for increased volatility in financial markets, shifts in global trade patterns, and changes in geopolitical alliances will shape the landscape for years to come. For the United States, the challenge lies not only in responding to China's moves, but also in proactively addressing the underlying factors that have led to this moment. The path forward will require careful navigation, strategic foresight, and a willingness to embrace new realities in an ever-changing world.